Hello everyone, welcome to week 10 lecture videos. Our today's topic is liability and liquidity management. We will be covering chapter 15 this week. First of all, we have few learning objectives as usual that we will be discussing one by one. And this is the outline for this week's presentation. First of all, in the last week from chapter 14, we learned that depository institutions and life insurers are especially exposed to liquidity risk. The essential feature of this risk is that financial institution assets are relatively illiquid in the face of sudden withdrawals of liability claims. The classic case of liquidity risk is a bank run where depositors demand cash as they withdraw their claims from a bank, and the bank is unable to meet these demands because of relatively illiquid nature of assets. For example, it could have a large portfolio of non-marketable commercial business loans. To reduce the risk of a liquidity crisis, depository institutions can insulate their balance sheets from liquidity risk by efficiently managing their liquid asset positions and managing the liability structure of their portfolios. Most depository institutions managers incorporate both asset management and liability management as part of overall liquidity management strategy. In reality, a depository institution manager can optimize both its liquid asset portfolio and the structure of its liabilities to insulate against liquidity risk. So in this chapter, we will discuss the various liquid assets and liabilities a depository institution might use to manage liquidity risk and the risk-return trade-off associated with various liability and liquidity strategies employed. So the sources of liquidity, management of liquidity risk requires an understanding of all sources of liquidity available to financial institutions. So we also discussed them previously, and these sources of liquidities are summarized when we discussed about asset liquidity or stored liquidity and purchase liquidity. Asset liquidity includes money market instruments such as treasury notes, treasury bonds, and short-term obligations, as well as certificate of deposits and bank-accepted bills. These are liquid in the sense that they can be traded readily with minimal loss of values. Generally, assets are considered highly liquid if they are of high credit quality and either of short maturity or very marketable with little chance of loss of value. However, such assets usually offer depository institutions low returns. Hence, the stock of liquid asset held in a depository institution's balance sheet will depend on two things. First one is the depository institution's willingness to trade off liquidity against return and depository institutions' ability to use purchase liquidity. These decisions, by and large, depend on the size of the depository institution, its reputation in the market, and related lender confidence in the depository institution. In addition to traditional sources of liquidity, financial institution securities securitize standard loans, particularly housing loans, and enter into loan sale arrangements. We learned them in a previous chapter. The use of repurchase agreement is another way that financial institutions can manage liquidity through stored liquidity. Finally, a financial institution can use the capital markets to raise funds via subordinated notes, preference shares, and even ordinary capital to finance its liquidity needs. However, it has to be noted that these involve a long-term process. That's why they are unlikely to be useful when there is a liquidity strain. Further, raising capital in such circumstances may send clear distress signal to the market. That's why a financial institution will typically want to avoid them as a source of short-term liquidity. Now, liquid asset management. A liquid asset can be turned into cash quickly at low transaction costs with little or no loss in principal value. Especially, a liquid asset is traded in a deep market where even large transactions in that asset do not move the market price or move it very little. So good examples of liquid assets are newly issued treasury notes and treasury bonds. The ultimate liquid asset is, of course, cash. While it is obvious that in financial institutions, liquidity risk can be reduced by holding large amounts of assets such as cash, treasury notes, and treasury bonds, financial institutions usually face a return or interest earnings penalty from doing so. Because of the higher liquidity and low default risk, these assets often bear low returns, reflecting their essentially risk-free nature. By contrast, more illiquid assets, for example, bank loans to commercial borrower, often have to promise additional returns or risk premium to compensate the depository institution for the relative lack of marketability and greater default risk of the instrument. Holding relatively small amounts of liquid assets exposes the depository institution to enhanced illiquidity and withdrawal run risk problem. Excessive liquidity can result in financial institutions' inability to meet required payments on liability claims, and at the extreme, it can result in insolvency of a financial institution. It can lead to contagious effect as well that negatively impact other financial institutions. Consequently, regulators tend to impose minimum liquid asset reserve requirements. So regulators often impose these liquidity requirements to limit the risk of a run on a bank that I have just discussed, influence monetary policy and taxation implications. So as I was just saying, that regulators often set minimum liquid asset requirements for at least two reasons beyond supplying, ensuring that depository institutions can supply to meet the unexpected liquidity withdrawals. The other two are, as I just indicated in the last slide, monetary policy implementation reasons and taxation reasons. So first of all, monetary policy implementation reasons. Many countries set minimum liquid asset reserve requirements with the objective of strengthening monetary policy. Especially setting a minimum ratio of liquid reserve assets to deposits or some other base limits the ability of depository institutions to expand lending and enhance the central bank's ability to control the money supply. A decrease in the reserve requirement ratio means that the depository institution may hold fewer reserves against their transaction account. Consequently, depository institutions are able to lend out a greater percentage of their deposits, increasing credit availability in the economy. Thus, a decrease in reserve requirements results in a multiplier effect on the supply of depository deposits and a resultant expansion of the money supply. On the other hand, an increase in the reserve requirement ratio means that depository institutions must hold more reserves against the transaction accounts on their balance sheets. Consequently, they are only able to lend out a smaller percentage of their deposits than before, thus decreasing credit availability and lending, and eventually leading to a multiple contraction in deposits and a decrease in the money supply. With regard to taxation reasons, the minimum requirement on depository institution liquid asset holding is to force depository institutions to invest in government financial claim rather than private sector financial claims. That is, minimum liquid asset reserve requirements are an indirect way in which governments can raise additional taxes from depository institutions. While these reserves are not official government taxes, having depository institutions hold cash in the vault or reserves at the central bank requires depository institutions to transfer a resource from the banks to the central bank. In fact, the profitability of many central banks is contingent on the size of the reserve requirement tax they can levy on banks under their jurisdiction. So that's the end of our discussion in this video with regard to liquidity asset management. In the next video, we will discuss the risk return trade-off associated with the liquidity management. Thank you very much.